Hey, everybody, welcome to Coffee with Joe. It's Friday, December 11th. We're talking about how the reformed monetary system would work after the passage of the American Monetary and Financial Security Act, which would create the reforms in the monetary system that Joe has been advocating. Joe's father advocated back in the early 1970s. Joe, if the banks couldn't create money through fractional reserve lending, how would banks make any money? What would their role be?
In order to really to discuss it, we have to talk about it as if it's already in place. That is to say, in other words, we've made a transition. Okay, and part of that transition, we talked about the fact that money would be being created, Pete. We've talked about that. Okay, that is to say, through the budgeting process, the Treasury and the Monetary Authority. So money is being created already. It's already going out into the economy, and because the way money in banking works, it is getting deposited into the bankers onto the balance sheets of the banks. So the banks collectively are seeing an increase in the amount of money that's available. Okay, now we've talked previously or earlier, Pete, about the concept of full reserve banking, and and what's happening here, okay, is the monetary system is becoming a national function, a national government function. Banking is going to strictly be a private function, okay? But what we've limited and what we've restricted the banks to is to using the amount of money that is being created. That's how we actually manage that. When we talk about economic stability, Pete, economic stability comes from monetary stability, okay? And what the banks would be doing, with the concept of full reserve banking would replace fractional reserve banking as the tool that the banks would use to lend real money, and in so doing, do what most people think they do now, which is actually make a profit on the differential between what they pay on deposits and what they collect on loans. The banking function happens through full reserve banking. Banks are limited to lending either the real money that they have, okay, or through interbank borrowing, borrowing from other banks in order to channel, the money where it's needed. But again, you have to accept, it sort of has to be a given that the right amount of money is available. Okay, and again, if the monetary authority and the economists, and just like the Fed's doing it right now, no different, Pete, have established the right amount of money. That right amount of money is in somebody's bank account, Pete. Okay, and the banks have the ability to lend that money out or not at the discretion of the depositor, of course. It's up to the depositor if they want to have their money lent out or not. Um, and the banks, the banks would function first of all from the view of the borrower. Okay, what the banks do, they accept deposits, and they pay interest and they lend money. Um, of the borrower would look exactly the same. Wouldn't look any different whatsoever, Pete. In other words, I want to go in and borrow, $20,000 for a car. I ask the guy for a loan. The guy says okay. He gives me a document that's a promissory note to pay it back. He gets the attachment of the car, still the same as they always did.
Joe,
Only difference.
wouldn't interest rates be higher under this system with the banks? That right now they can take $1 and lend out 10 based on it. If they could only lend out $1 for every dollar deposited, wouldn't they have to charge more interest?
No, no, because well, what actually determines interest rates, Pete? Okay, what actually determines interest rates? If the bank is lending, I'm going to say, $100, okay, it's lending that $100. It's paying. It's collecting the interest payment on that $100. And if it's collecting interest on every loan it makes, why does it have to collect more? It's not it's the money supply is going to be exactly the same.
So
So
it's not going to be limited in the amount of money that it has available to make loans if it can't multiply a dollar into $10 in loans?
no, it's not. It's not because all the money is going to be created. All the money is going to be deposited. All the money is going to be there in the banks. The exact same amount of money, if you will, nominally the exact same amount of money. And
Right.
by that I mean a process has been used to determine the right amount of money. That amount of money is in the bank. It'll either be lent or not lent. And if it's lent, it's going to be on exactly the same basis. It's going to be lent on the basis that I'm going to use some depositor's money and I'm going to pay interest to that depositor and I'm going to lend it out and I'm going to make my money on the spread. It's true that the banks won't be able to do certain things that they're doing right now. Okay, Pete? But most of those things that they're able to be doing right now is by virtue of of their powers. Why is there a credit card, part of that money system that's creating that's charging 20% interest right now? None of that stuff would be able to happen. It would be impossible for that kind of stuff to happen, Pete.
I'm wondering what would happen on the what you call the shadow banking side. This M3 money's creation, all this financial ephemera, derivatives, credit default swaps. Would that be affected by this? Would those
Oh
problems be
yeah,
solved
yeah.
with this
For
reform?
first of all, I have to say after the settling of accounts, Pete, okay, because they've created all that stuff which has nothing to do with the real economy, and a lot of that stuff has to go by the wayside. So, and with the a lot of the investment banking community has to go by the wayside. To me, what needs to happen on the investment banking side is quite very simple. Um, they need to lend real money. They need to really become investment trusts of real money, Pete. That is to say, the investment bankers, ability to leverage has to be limited in such a way, Pete, that they can't do what they've done now, set up an alternative outside unregulated financial structure, Pete. That if that part of the structure fails, it takes the whole thing down with it. Okay. So we need to limit the risk to the economy and the monetary system from anything that happens by anybody that has a license to create anything, such that the risk stays in that part of the system. Absent that control of the risk, none of it should happen, Pete. It should all be investment trusts. It should be using real money, pooling real money, and lending out real money. And so to me, really, the shadow banking part of it is going to go away. The investment banking part of it is going to be more connected to the savings bank part of it because people are going to want to lend money by term. Okay, if I've got $1,000, you can lend it out for five years. That's in the 5 year pool of money. For 10 years, give me a guarantee for 15 or 20 years, you can lend that out for 15 or 20 years. But the ability of those institutions to create things that serve as money and that create debts that can have the ability that if we don't pay them back can bring the whole system crashing down needs to end, Pete. That's how we really get economic stability through monetary stability, through having rational processes of ensuring that the money that's created matches the need for the economy.
We'll talk to you again soon.
Thank you.